Good afternoon and welcome to Weekly Musings. So, what I want to talk to you about today is the recent Federal Reserve statement on longer run goals and monetary policy strategy. So, this was adopted in 2012 and it was reaffirmed yesterday. So, basically, effectively today, Jerome Powell, who is the chairman of the board for the Federal Reserve Bank of the United States, gave a speech today and reaffirmed this monetary policy strategy. So I just want to go over this with you. So we haven't gotten to monetary policy yet, but monetary policy is the policy that is enacted by the Fed, the Federal Reserve Bank of the United States. It is not a government entity. It is independent of the government, although the members are appointed through the government, but it does act independently. So when we talk about monetary policy, we're talking about money and the interest rate. When we are talking about financial policy, then we're talking about anything that has to do with making laws or collecting taxes. So we're talking about monetary policy. So this is the availability of money. And if you think about money as having a price associated with it, so let's just think about the demand and supply of all goods. You have the quantity demanded and the quantity supplied, and that relates to the price of the good. So let's pretend that money is simply another good. So just like blue jeans or concert tickets, money is a good, and the price of money is the interest rate. So if you were to go to the bank and get out a loan to buy a car or a motorcycle or even a student loan, you pay for the privilege of using other people's money. So the amount that you pay is the interest rate. Similarly, when you deposit your money in an interest-bearing account, whether it's a savings account or a brokerage account or a certificate of deposit, and the financial institution pays you for the use of your money, again, you're being paid to park your money there, basically. They then turn around and loan that money out, and they'll charge a higher interest rate. All right, so that's just sort of a brief overview. So now we're talking about the Fed. So the Federal Open Market Committee is the arm of the Fed that is charged with carrying out monetary policy. And there are multiple tools that they can use. They can buy and sell government issued securities on the open market. That's one thing that they can do to manipulate the supply of money. And if you're manipulating the supply of money, then you're also manipulating the price of the money. So by manipulating how much money is out there, they can also manipulate the interest rate. All right. So they can also change the discount rate, which is the discount rate is the rate at which a bank would pay to borrow money. They can also change the federal funds rate. The federal funds rate is the rate that banks charge one another to borrow money. And then they can also change the required reserve ratio. The required reserve ratio is the percentage of total deposits that banks are required to keep in the bank, either in the vault or at the Fed, as security in case there's a bank run, which happened like in the 20s. So that was a lot of background, but now we're talking about the Fed. The Open Market Committee is firmly committed to fulfilling its statutory mandate from the Congress, and this is what Congress has tasked the Fed with: promoting maximum employment, stable prices, and moderate long-term interest rates. So then we go down. You can read all of this if you want. I will put the link in the announcements. But basically, employment, inflation, and long-term interest rates fluctuate over time in response to economic and financial disturbances. Monetary policy plays an important role in stabilizing the economy And it says the committee's primary means of adjusting the stance of monetary policy is through changes in the target rate for the federal funds rate. So this is important because this is different. As recently as just a few years ago, the tool that they used the most was open market operations, which is buying and selling government issued securities. So these are like T-bills and treasury bonds in the open market. So now they're saying this is the primary means, changes in the target rate for the federal funds rate. So the Fed can't set the rate for the federal funds rate. So the federal funds rate, remember, is the rate that banks charge one another to borrow money. So for instance, a bank says, I don't have enough money to meet that required reserve ratio. I need to borrow $1 million overnight. They could go to the Fed and the Fed would charge the discount rate. Or they could go to their buddy bank down the street and say, hey, what will you charge me? And that's the federal funds rate. So the Fed cannot set that rate because that rate is a market set rate, meaning it's all about supply and demand. But they can manipulate it through their actions. And so that's what they're saying. They can set a target. They'd like that rate to be in somewhat of a target area, and that's what they're going to try to do. So again, it says the committee is prepared to use its full range of tools, and we talked about that, the discount rate, the federal funds rate, open market operations, and what else? The required reserve ratio. They were prepared to use the full range of tools to achieve its maximum employment and price stability goals. The maximum level of employment is broad-based, inclusive, not directly measurable, changes over time, blah, blah. So it says it's not appropriate to specify a fixed goal. Rather, we're going to be looking at all these other things, a wide range of indicators to determine what is the best rate or the target rate of unemployment. Then they say the inflation rate over the longer run is primarily determined by monetary policy, which is the manipulation of the supply of money. And they say they reaffirm the judgment, this is important, that inflation at the rate of 2%, so that's a little lower. We've usually said it's been about 3%. They're shooting for 2% as measured by the annual change in the price index, which is the CPI. We've talked about that already. The CPI for personal consumption expenditures is most consistent. So they're saying in the long run, they'd like to see inflation at the rate of 2%. And that also means that would be the growth rate of the money supply. So they judge that long-term expectations that are well anchored at 2%, mean price stability and moderate long-term interest rates and so on and so forth. And how are we going to do that? They're basically just saying in order to do that, they're going to be, doing monetary policy, trying to influence economic activity, employment, and prices. And then they say sustainably achieving maximum employment and price stability depends on a stable financial system. So when we get to talking about money, we're going to learn that our dollar is what's called fiat, which means that it is not backed by anything. It's not backed by gold or silver or anything other than the trust that the government will keep that value stable. So that's what they're talking about, a stable financial system. Therefore, the committee's policy decisions reflect longer run goals, medium-term outlook, and assessment of the balance of the risks. So this, again, I'm going to post it for you, just is sort of telling you that the Fed, they're headed in a little bit of a different direction. And when we get to monetary policy, we'll go into this in greater depth, but I just think it's very interesting because this is happening right now. So if you have any questions, please don't hesitate to let me know.